Just to reiterate to everyone that we are talking about financial statements and understanding the business from the numbers point of view. And it's a language of the business, so we need to know this in order to understand the healthiness of the business. Should we invest in the business, or should we say it's too difficult, we should pass on? So in order to do this analysis, we need to understand the numbers and what does the numbers tells us. So that's the journey we started 2 3 weeks ago, and we'll be continuing on this journey for some more weeks before we conclude this area. So I also started putting a Word document together so that you could we would use this as a framework to analyze the business um, for the future use cases. So my goal is to explain you how to look at the business from different angles. Once that is being done, I would expect we will do some business analysis together. Um, so somewhere in January 2023. So I guess next 2 months, 2.5 months, November, December, half of October, we will try to get some framework to analyze the business. So in that framework, one of the angle is financial analysis. So we would look at the financial aspect of the business and see if the business looks solid or weak or dangerous. It could be some businesses are very dangerous in the sense financially they are not doing quite well. They have debt of 10, debt to equity of 10, and they are not making any profits. So those business we categorize them as not too good business or dangerous business. It's not good for the investors. It will eat up all our money, and we will never make any money out of that business. Okay. So hopefully sometime in January, I expect you to expect you all of you to use the framework that I'm putting in this document, Word document, to analyze. We'll pick up a business. We can pick up any business in the world. It doesn't matter. And we'll pick up the business. We look at the business from the financial angle, business model angle. I remember, I hope you remember, we talked about the business model canvas. We looked at some business models. So we look at the business model angle, and we look at the management, and we also look at the financials. And then we will say whether a specific business is good or bad. Okay, so that's the goal we are all working, and that's the goal that I'm also thinking that once we done this different analysis, we should go back and pick up one business and connect all the dots that we have been talking over the last 50 sessions, 49 sessions. Okay, any questions you want to ask? Anything did anybody look through the document and any? So I put the financials here, but I'll add other sections over the weeks in this document, and I would ask you to look at this document and do the analysis of a business based on this framework that I'm putting in the document. Yeah, Arush.
Uncle, can you send this into the group again?
Yeah, I can do that. You mean WhatsApp group or chat here?
WhatsApp group.
Yeah, I can do that. Yeah. Okay. So we are looking again the financial statements, and I found another better video to understand this from the expert. So let's listen to this video And at same time, I will take example of one company on screener in India, and we will look at those numbers. But my goal for you is to understand the basics, fundamental, the reason why we are doing this analysis. Can anybody explain in simple term why are we talking about this for weeks and weeks? Can anybody tell me why we are looking at the financial statements of the business? The reason why we are looking at the financial statements of the business is to understand, is this business healthy, good business, profit making business? Does it makes money for investors or not? That's the reason. I gave you simple analogy. If you want to pick a best cricket player for your IPL team, imagine you are building an IPL team or a football team, and you want to pick up a good football player or good cricket player. What would you be looking at? You would be looking at his history, how did he performed, and you would also look at his if he is a baller, how what are the different balls he can ball, and if he is a player, what are the different shots he can play, and his batting average, and etc etc. Similarly, for businesses we will be doing the same. So the way we can analyze the businesses is looking at the numbers that they publish every quarter. Quarter means every 3 months, and every year, every 12 months. So businesses are publishing numbers every year. So we could look at the numbers of a given business for last 1 year, 2 years, 3 years, 5 years, 10 years, to understand, is it a good business or bad business or worst business. So that's the reason we are doing this analysis. And the second reason is, in financial world, if you want to invest or partner with any business, I I expect we should have a simple understanding of what does the business do? Is it a good business or bad business? So that's the reason we are doing this analysis. Okay, so that's the reason I'm spending uh, quite a lot of sessions on this topic, because this is very important for analyzing any business. Okay, so
Here is a basic income statement of profit and loss of a business. What you expect to see is revenue sales going up to a level that you can understand. As your cost of goods or cost of manufacture or cost of services go up, typically, if possible, and I appreciate it's not always possible, but by and large, you put up the cost to your clients. So what that means is the gross profit percentage or the gross profit margin, which is gross profit expressed as a percentage of revenue, year on year doesn't change much. Okay, it changed by very, very small, minute amounts being mathematics. Likewise, as all your overheads go up, at least by inflation and sometimes more, you pass it on to your client through your prices. So this means that like the gross profit, the operating profit margin likewise doesn't change from year to year, or not by much. And by that we mean operating profit as a percentage of revenue, as a percentage of sales. Finance costs or interest implies you've borrowed some money, and we'll come on that in a bit. That gives you profit before tax, and then taxation. Well, obviously, all countries vary in their taxation regime.
so he's basically explaining what are the basic blocks that we have in the income statement. So we have revenues, that's what the money that business makes, and gross profit is the money that business can keep after cost of good sales. So COGS is the expenses that businesses spends on the goods it's selling, and then this is the gross profit. On top of the gross profit, the overheads, the employee expenses and everything. After that is been removed, we get the operating profit. So in the business, you need to look at the revenue growth. This is something you can find. We can find it from the income statement, and we need to look at the gross profit growth for the business and also operating profit growth. So this terms is basically uh, revenue is nothing but the money that the business makes, and the gross profit is the money that business uh, can keep after all the expenses, and then they have to pay for the employees and the buildings. Then after they pay out all their employee costs and the power bills and everything, then they have the operating profit. On the operating profit, they have to pay the taxes. So government taxes to the government, and if they borrowed money, they also pay the interest to the bank, and then you get a profit before tax and then profit after tax. So profit after tax is the actual money that the investors or the owners of the business can keep. So gross profit, if you tell me gross profit, operating profit, that doesn't that's not the real money that the investors can keep it. It's the profit after tax. That's the money that finally, after paying taxes, everything, that's the money the investor's going to keep. So basically here he's explaining the income statement. Okay.
But because tax is roughly the same percentage every year, and if your borrowings haven't changed too much, for the same rationale as the above two, the profit after tax or the net profit percentage, and again expressed as a percentage of revenue, typically would not change by much every year unless there had been some changes in the business. So we have a profit. Well, good, bad? Well, good or bad in respect of what? Visualizing a balance sheet, and of course the real balance sheet.
So now he's connecting the income statement to the balance sheet. So now the question he's asking is, okay, we made a profit, but that profit number doesn't tell me anything until I know how much assets the business is using. Let's say if I have assets of 100 crore, and if I made profit of 10, if I just tell you, hey, I made a profit of 10, then you would not know until I tell you, by the way, I have assets of 100, then I made a profit of 10. Then you would say, okay, you made 10% of profit, because 10 crore out of 100 is 10%. But somebody comes and tells you, hey, my business made 20 crore, but that doesn't tell you anything. Then the next question you should ask is, okay, what does your business, what assets that your business owns, on which assets you made this 20 crore? If the guy tells you, I made this on $200, then you would say, okay, so that means you made 10% profit. That's not bad, that's not good, but it's okay. So if somebody else comes and says that, hey, I made uh, 40 crore profit, then you would say, okay, I understand you made a 40 crore profit, but against what? Could you tell me what are the assets? Only assets, the assets can be found in the balance sheet. So you will go and connect this to the balance sheet, and the person will tell, oh, I have an assets of 100 crore. Okay, that means out of 100 crore, you made 40 crore profit. On the 100 crores asset, you have 40 crores profit. That means you made 40% profit. Wow, that's a great business, because any business makes more than 15% on assets. That's a good business to think of. So in the finance world, you anybody tells you a number, it doesn't give you any meaning until you connect that to the overall picture. Okay. I think I give you an analogy. If I tell you my weight, it doesn't give you any analogy or any useful information until I tell you my height and my fat percentage and all other things before you can judge if I'm healthy or fat or all those things. Similarly, for the business, if somebody just tells you the net profit, it doesn't tell you anything until you know how much assets they had and how much cash flow they made and etc. That's the reason you need to connect that to the balance sheet. So that's what he's doing here. Okay, now we looked at the net profit from the income statement. Let's look at the assets what the business has, so that we understand whatever the net profit the business made, is it good or bad. Okay, does this make sense, or any question you want to ask? Okay, so now we are looking at the balance sheet.
Are not presented in this format. This is for purposes of illustration. We have shareholders' funds, which is what the shareholders have put in, plus profit, which they've kept back over the years. There could be long-term liabilities, long-term borrowings, and there could be others. And there could also, or there more likely to be some current liabilities, small short-term borrowings, trade suppliers, things like that.
So again, in the balance sheet, we have fixed assets and current assets, uh, and the liabilities are the debts. So long-term debts, short-term debts. Basically, debts are the money that a business raised to, put up a new plant or put up a new factory. Um, so that's a long term, 10, 15 years debt. Current debt means short-term debts. Should the businesses borrow money for a 6 months or 1 year period, that's called short term. And they use this for mm, working capital. I mean, working capital means to run the business. In order to run the business, we also need funds. So that can be arranged with the current borrowings, short-term debts.
That's basically what funds a business. And those funds will be reinvested in fixed assets, property, computer equipment, airline, for example, aircraft for an airline company. And they would also have inventories and similar things if for most businesses. So when we look at the profit, we ask the question, well, profit, good or bad, for whom? And I guess one of our starting points has to be the owners, the shareholders. So in the first instance, the shareholders are going to say, this is our capital. This is what belongs to us. And it's made up typically of two tranches, the share capital which they physically invested and profits which the company possibly would have kept back over the years. So sometimes this is called net asset value, sometimes this is called total equity. So I divide the profit after tax by this to give me what's called the return on equity. So the owners take a view as to what return they've had on their business.
So that's also one of the parameter we are considering, return on equity in our framework for doing the business analysis. So what does we are checking here? We are checking the net profit, net income. I know in the finance world it's crazy. They use many terms for same thing. So don't get confused. Somebody uses profit after tax, net income, bottom line. These are all telling you one and the same. It's a profit after paying all the things. So that's net profit or net income. Okay. So what we are checking here is we are checking for the net profit that the business made against what are the shareholders' equity. So we are comparing for the shareholder equity. Suppose if I put 100 crore as my shareholder equity and I made 10 crore as a profit, then 10 divided by 100 into 10 divided by 100 because 100 is my equity. So you get 0.1 and then you multiply that with 100 in order to convert it into percentage. Okay. Does this making sense or should I take?
It makes sense.
So let me show you the real example. So I'm taking a company called BSC Limited. This is the company I'm taking example here. And if you see here, so the return on equity of this company is 10%. Okay, so how can we calculate this one if I go back? So I'm now going back to profit and loss statement. So I'm looking at the net profit. Can you see here the net profit 245 crores. This is per annum. So this is 2022. So show it here. Just a second. So again, it's the same company, BSC Limited. So now we are in income statement, profit loss statement, and we are looking at the last year. So last year, after all their expenses, they made 245 crores against what 841 crores revenue. So they made 245 crores. So this is the money that they made for the year for that that's from the income statement. So now look at the balance sheet and the total assets they have is 6,181 crores. So now if you take, let me take the calculator. So what was the profit? 245 crores. So 245 divided by what is the these are the reserves and yeah. So these are the total assets that the business has. So 6,185 times 100. So they made a 3.9%. But now here we are taking, I think we should take only this one. This is the money the shareholder has put together. The rest of the money is so we have to calculate against the money that the owners owns. If you look at the shareholder funds, so shareholder funds of the equity they raised and the reserves they accumulated over the years. So it would be 245 crores against 2,627 times 100. So this is 9.32. So it's around 10%. So that's how the return on equity is being calculated. So basically, return on equity tells me for the shareholders' equity, how much money does the business made for the business owners. That's the key measurement we would be looking at. So that's also one of the key parameter we have in our financial analysis. Okay, let's go back here.
But then they further say, hang on a second here. Not only as a shareholder you have my money, you've also borrowed money. And debt is just another form of capital. So let me judge your performance on the total capital that you have, which is a combination of the shareholders' capital and monies that you may have borrowed. There are wider issues here, but we're keeping it simple for the time being. And we call this return on capital employed, which is the profit on all the capital at the disposal of the business. And that
So that's another parameter. We could also find that here, return on capital employed. So if you look at the return on equity, here we are accounting only the shareholder money. But here, when we calculating return on capital employed, we are accounting both shareholders' money plus the money that the business borrowed. So we are doing this uh, together. That's a return on capital employed.
gives you an inkling as to how well the company is actually using its capital. So, you borrowed money. How much? Well, how much vis-a-vis what? And one expression of debt is what we call gearing or financial leverage. We compare the total debt against the equity of the company, meaning how much have you, the owners, put in and how much have you borrowed. We call this gearing. Now, there's no magic figure here. I think what matters is, do we understand why that business is borrowing? Can we validate the presence of borrowings in that business? And unless you've had a major acquisition, a restructure, something extraordinary, typically businesses borrow for three main reasons. One, is there a loss? If there's a loss, it implies very simply expenses bigger than revenue. Someone has to fund that. Or capital expenditure. Capital expenditure meaning we need to replace fixed assets. And therefore we ask the questions, what have you bought? Why have you bought? But also how well you are using those assets. And one measurement, there are a few others, we call return on assets, which means just that, which is profit divided by total assets. How well are you utilizing the assets of the business? Another question we would also ask, which would possibly necessitate borrowings, is what we call working capital. Let's say we're dealing with a buy and sell business. It's probably easier to visualize. I buy my stock and my inventories today, and my stock and my inventories sit on my shelves for about 30 days. I make a sale and I give my debtors, my trade payables, 30 days to pay me. I'm out of cash for 60 days, from the time I made the purchase to the time I physically get cash from my client. My suppliers will come in. They might give me 30-day credit or 40-day credit. But for most businesses, it creates an imbalance. I'm out of cash for about 60, but I'm getting finance for about say 20, 25 or 30. I have what's called a working capital gap. And this would require funding as well. So we've established the presence of borrowings. I understand why you borrowed. And I guess the next question we have to I working capital. Let's say we're dealing with a buy and sell business. It's probably easier to visualize. I buy my stock and my inventories.
Do you understand this? When we talk about working capital, this in simple terms, the money required to run the business. So let's take an example of supermarket, right? So if you take the supermarket, all the goods that you see it in the supermarket, Rima or Fortex, whatever the shop you go and visit, whatever the goods that you see in the supermarket, they are not manufactured by them, isn't it? It's coming from some company who is manufacturing, not some multiple companies who are manufacturing the goods of different products, coming from, bread all the way to the clothes. They are manufactured by different. So we call them suppliers for the supermarket. So suppliers supplying the goods, and that goes into the shelf. But from the time you put it on the shelf to the time you make a sales, it sits there in the shelf. It's time from the time you purchase the goods till the time you purchase the sold the goods. So you purchased the goods today, but you sold the goods in 60 days. So let's say you purchased goods worth of 100,000 Danish krone. I'm taking a simple example of a simple supermarket. So that 100,000 krone uh, is sitting in that supermarket for one, let's say they take 2 months to sell those goods. Then it's sitting there uh, for 2 months doing nothing. I mean, it's not generating any cash for us as the owners, but as a business, they have to purchase this. So this is called working capital. So if you look at the grocery stores, the amount of the time that the item sitting in the grocery stores changes quite a lot, because bread is sold within days, milk is sold within the days, fruits, meat, and everything is being sold within days. But compare that with a furniture shop like Jisk or IKEA. If you look at those, their shelf life is longer, because their capital is sitting in on the shelf for a longer period of time. Uh, so this is called working capital. But some businesses, suppliers can live with the fact that the businesses pay, after 30 days. So suppose Rima has a very good reputation, or Fotex has a very good reputation of paying back all their suppliers, because I am the supplier of, diapers or whatever the product I am manufacturing as a business owner. I may give a credit to Rima or Fotex, because I think they are a very good customer of mine, and then they pay me the money in advance. So I can give them 30 days credit for them to pay back the money. So that means by the time I deliver the product, I will not ask them money until 30 days. After 30 days, I'll come at knock at their door, and I expect them to pay me money. I don't care if they sold my product or not, but I expect them to pay me money. So, so if the business has 60 days life cycle of selling that product, then 30 days credit I gave to them as a business owner, but remaining 30 days they have to bear it by themselves. So for that purpose, many businesses borrow money from banks or lenders. It's called a working capital borrowing, and it's also listed as a current liabilities in the balance sheet. So whenever you see the current liabilities in the balance sheet, it's a money that the business borrowed for the temporary purpose, 2 months, 3 months, 6 months, or within 1 year. Okay. Does this make sense or is it getting too complicated? Okay. No answer.
Today, and my stock and my inventory sit on my shelves for about 30 days. I make a sale and I give my debtors, my trade payables, 30 days to pay me. I'm out of cash for 60 days from the time I made the purchase to the time I physically get cash from my client. My suppliers will come in. They might give me 30-day credit or 40-day credit. But for most businesses, it creates an imbalance. I'm out of cash for about 60, but I'm getting finance for about, say, 20, 25, or 30. I have what's called a working capital gap. And this would require funding as well. So we've established the presence of borrowings. I understand why you borrowed. And I guess the next question we have to ask ourselves is, can this business afford those borrowings? Now, there are a number of ways of looking at this. Going back to the profit and loss income statement, I have to pay the bank interest or finance cost. How many times is that covered by the profit? At least, is my interest safe on that level of performance for the year? That's one way of looking at it.
So here, what is he looking at? It is he is looking at if a business borrowed money. So when you borrow money, what would be your cost? You have to pay interest. So now he is looking at, is this business is able to serve its own interest obligations every 6 months? The business has to pay back interest, right? So it's asking, can this business serve the interest uh, payment obligation within 3 6 months? So he's comparing against that to the profit the business is making. So if you looked at the business, maybe I can show you. So let's look at the Tata Motors. Okay. So Tata Motors, how much they borrowed. So their debt to equity is, where is debt to equity? Yeah, 3.25. So let's look at their balance sheet. So they have borrowed 100 and, wow, lot of money. Okay, 146,000 crores. Okay, so this is the amount they borrowed. Okay, now for this amount, if they have to pay interest, let's assume for simplicity, let's assume they have to pay 10% interest of this borrowed money. Can anybody tell me what would be 10% of 146,000? So 10% of 146,000 would be 14,000, right? For 14,600. So they they have to pay interest amount of 14,600 every year. Okay. So now we look at their net profit. So let's look at the net profit. Oh wow, they don't made a profit. So they're actually losing money, 11,000 crores. So for this last year they lost 11,000 crores. One side you have an income statement where you are not making money, so you are losing 11,000 crores. On the other side, you have borrowing cost of 14,000 crores. in total, how much Tata Motors has to pay every year? So 11,000 is to fund their losses, plus 14,000 is for their interest income. So it would be around 25,000 crores. So in this case, it's really in bad shape at this point of time. The reason is it's even can't fulfill their obligation of paying the interest for this amount they borrowed. So that's 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 the thing he's looking at now. I look at the finance cost. So Tata Motors has the debt of 146,000. So I made it simple. Let's assume it's 10% interest that the Tata Motors need to make. And I'm comparing that 10% interest, 14,600 crores against the net profit. But when I looked at the net profit, it's a negative amount. Sorry, I should not look at the net profit. I should look at the operating profit before the tax. So what is the operating profit? It's 24,000. So out of this 24,000, 14,000 is going for the, you see here, they paid already, they are paying 9,312 crores. So it's a two times of the interest amount they have to pay. So that's only out of their operating profit 24,000. In our example, 10% interest rate, it's 14,000, but actual interest they are paying is 9,000. So I think they have borrowed for less percent of interest. So I think it's around 6-7%. But even though it would be three times. So if you are paying 9,000 crores as a interest amount, how many times this in the 24,000? Around three times, right? So that's what he's looking at.
Better way would be to look at the cash flow of the business. Essentially, we are saying that we look at all the cash in during a year and all the cash out during the year. What is driving cash? What is absorbing cash? And hopefully in is bigger than out. And if not, why and why are you funding yourself? Because it is cash flow that repays debt, absolutely nothing else. And we call this liquidity. And the cash flow of the business not only will support that the debt is capable of being supported, but also gives you a strong understanding of the overall cash position of the business. So in summary, if you were to write a financial report on a business, you might find the following structure and template very, very helpful. And we've seen those themes already in this very, very short clip. Growth, is the company growing? Increase in revenue, how has the company increased? Is that growth sustainable? Can they keep growing like that? Profitability, is the company profitable? And we measure those in the first instance of our margins. We looked at gross profit margin, we looked at operating profit margin, we looked at net profit margin, and we concurred year on year they shouldn't change by much. So that's one.
So we are measuring the business from the profitability angle. The profitability angle can be measured in with three parameters: gross profit, operating profit, and net profit.
One aspect, the margins of profitability. The second aspect is that profit is good for whom and vis-a-vis what? Well, one first question is for the shareholders to ask, how well are you making a capital work? We call this return on equity, which is profit divided by shareholders' funds. The shareholders asking a very valid question, are you making a decent enough return on our investment? But then a second question is posed in that, hang on a second here, not only you have our capital, you've also borrowed money, chances are. So I would judge your profit performance on all the capital at your disposal. And we call this return on capital employed, which is combination of what we've put in, i.e. equity, plus debt, what you may have borrowed. And we call this return, again, on capital employed. So profitability has two strengths: margins and utilization of capital of shareholders and all providers of capital, which will be debt people. So a company has borrowed money. Why could it have borrowed money? Well, one area we call efficiency, i.e. the chances are it's invested in fixed assets. It's invested in assets. How well are you utilizing the assets at your disposal? And one measurement is return on assets. The second line of inquiry is apropos working capital, which we've seen already. Is there a working capital gap?
Return on equity, I just want to tell you a small story so that you understand this message. So let's assume you are into business of running airlines. So let's take Ryanair or Lufthansa Air or Etihad or Emirates, whatever the airlines that you've flown before. So you are into airline business, and you are a small airline business. You have 10 aircrafts to run 10 different routes. Okay. So each aircraft you bought it for 100 million Danish krone. So you paid for each aircraft for 100 million Danish krone. So in total, how much assets you have? Can anybody tell me if I have 10 aircrafts, each cost me 100 million Danish krone? How much would be my total assets? 10 times 100 million is 1,000 million. That's 1 billion. So I have 1 billion worth of assets sitting on the ground. So if this aeroplanes uh, flying only 4 hours a day, so we have total 24 hours, then 16 hours my assets of worth 1 billion doing nothing for remaining 20 hours. So that's the reason you see many airlines, they want their airlines always on the air so that it can make money, because these are very expensive assets. They don't want to keep them on the ground. They always want to fly. That's the reason they offboarding process is very fast. If you see, they try to offboard the passengers as soon as possible, and at the same time onboard the passengers, so that the amount of time it's standing on the ground is less. So typically, if you look at a very efficient airlines like Ryanair, few others who are making profit, they typically run their aircraft on the air more than 16 hours in a day, so that they can get the maximum amount out of their asset. So this is mm, again, it all depends on the business model. Some businesses are capital heavy businesses. Some businesses are capital light, asset light businesses. So if you look at the airline businesses, they are asset heavy businesses. You can't make any money until you buy this 1 billion of worth of um, flights on the ground. But you have some other businesses like asset light businesses, like Google, Facebook. They consume very low assets, but they throw out a lot of cash out. So you also need to think, when you look at from the business model point of view, is it a asset heavy business or asset light business? Maybe we can look at this when we look at the businesses analysis. So let me make a note here: asset light, asset heavy businesses. So we have a return on free cash flow, dividend yield, market, return on okay. Any questions? Anything you want to ask? So let me show you another example. Maybe let's finish this one then.
And if there is it satisfactory, and does it need to be financed? And those two lines of inquiry talk to us about efficiency. So there has been borrowing. Well, this is what we refer to as solvency. How much have you borrowed? No magic figure. We call this gearing or sometimes financial leverage. Why have we borrowed? Explained by a loss and or working capital and or acquisition of fixed assets or assets, capital expenditure. And we seek to understand the presence of these borrowings. Next key question, can the company afford these borrowings? Only cash flow will tell us that. And this is where liquidity comes in, where we look at the entire cash performance over a year, and we look, put very simply, at cash in and cash out. And hopefully cash in should be bigger than cash out. If not, why not? And how is the company actually funding its business on a year-by-year basis? And finally, you may be looking at that business as an investor. And the last key point, I guess, is investment attractiveness, i.e., is that company worth investing in, given all the parameters that you've just seen? Et voila, doesn't take long, does it?
He used the financial statements and gave reasonable insights how you could look at the different numbers, connect them back to the overall business profitability, efficiency, bankruptcy possibilities. Are they able to fulfill the obligation to pay back the interest and the borrowing the borrowed, I mean, money that they borrowed. So that's what he um, explained it. So, okay, any questions? Is it getting overcomplicated, or is it making sense, or is it making sense but it's not clearly understood, or where is the current state?
It's good, Uncle. I understand.
Okay,
I understand it.
okay. But we'll take a few company examples and we will do this analysis so that it makes more sense. So hopefully, once we cover these sessions until December, in January, we would take a few examples and we will run through the same analysis so that it makes more sense for you. Okay, so let me do simple quiz before we go. So let me use whiteboard for this. So you looked at the business. Okay, this is the business, you looked at it, and you found out business is growing. Okay, growing at 15% every year. They are growing 15% every year. Okay, and this growth, 15% this growth require funding? Does the growth require funding or not? If you want to grow your business, let's say you have one supermarket today, but you want to expand it to 10, 15, 100 supermarkets. I mean, you have one shop today, you want to expand this to 100 shops tomorrow. So, or 15 shops. So you have 100 shops today and you are growing at 15%. So that means you are expanding every year 15 shops. After 1 year, you have 115 shops. Second year, again 15% growth. What would be second year number of shops we require? 115, 15%. How much it would be? Around 116 shops. So we sorry, around 16 shops we need to grow. So here 16 shops. And let's say each shop, establishing each shop, I need 10,000 crore, 10,000 DKK. And I need for 15 shops, I need to multiply. So I need 150,000 DKK. Okay. So this is what I need in order to grow my business at 15%. Okay, I need to open 15 shops. Each shop required 10,000 kron for 15 shops. I need 150,000 DKK. So for 100 shops, I made a net profit of 100,000. Okay, I made 100,000 net profit. This is the profit after paying all the taxes and everything. So in order for me to grow 15%, how much extra money I required now? Does this make sense, what I'm asking? And does this logic understood what we are trying to do here? I have 100 shops today, and I want to grow it 15% every day. So I'm sorry, every year. So that means I want to open 15 shops first year, year one. And year two, I want to open 16 shops because after first year, it will become 115. So I'm 15% of 115 would be 16 shops around. So next year I need to open 16 shops. For 15 shops, each shop it cost me 10,000 kron. So for 15 shops I need funding of 150,000. But when I go and checked my bank account as a business owner, I found out from 100 shops I made only 100,000 last year profit. So this is the amount I have, but I need 150,000. So as a business owner, what are the options I have to go and raise this 50,000 extra I require to fund this business? Yeah, Arush.
Uncle, you could do IPO.
Okay.
You could take a loan,
Yeah.
or you could ask the investors to give some money.
Exactly. Beautiful. Yeah, that's the reason businesses go and raise money. So they use they go and ask banks to lend money. That's a loan. So I have a gap of 50,000. I can go and raise, or I can go to investors. I can go to public and raise money, or I can go to the existing investors and tell them, hey, this is a great business. Do you want to put more money into this business? Okay, so this is how companies end up raising money. Okay, and then need of money. But in general, is it a good business? Any business, if it can't sustain its own growth, it's not a good business. So we need to look at the businesses that can fund its own growth. I want my business to fund the growth as well. But again, it all depends on the CEO, right? The guy who is running the business. He wants to grow faster than the money that the business is throwing out. In this case, instead of growing 15%, he could have grown 10%. So that means he need to establish only 10 shops. Then he need only 100,000 DKK that can be funded from the profits he's making. These are the businesses which are good. These are the businesses which shoot for higher growth than what they are making. They are sometimes good, sometimes bad. Does this make sense? Why we are saying the businesses should not shoot for the higher growth, and we should look at the businesses who can fund their own growth. Yeah, Arush, you have a question?
No.
Okay, so it's a simple food for thought exercise I try to do before we close. So you understand how businesses grow and how they fund their growth. Is it from the internal accruals, or is it external funding like Arush mentioned, IPO or loan or investors, raising money from investors? Okay, with that, let's conclude it here, and I will expand the document, and then you could look at them time to time. Okay, thank you, and I wish you a good weekend.
Thanks, Uncle.
Bye.
Thank you.
Bye.